Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today talking about investing, the economy, all those important things to make your net worth grow here. And we got a lot of things to cover today. We want to talk about the annual home sales. Things are not going quite the way people want them to. Also, delinquencies. You hear this in the media about, they're terrible and so forth. We'll talk more about that. Not as bad as the media makes it out to be. Also want to discuss core PCE, which is a personal consumer expenses. We'll talk about that. And then also more on the real estate market. Again, things that help you manage your portfolio and your net worth and stay on track. Chase?
Hey, yeah, well, good to be here as always. And you want to kind of, I'm going to say, join this show indirectly here, but you got a question, a stock you're looking at, buy, sell, hold. We'll break down those fundamentals for you. All you have to do is go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You'll see at the top of the webpage there, radio show questions or smart investing show questions. Click that, type in the question, and we'll get those answered. I know we have a little bit of a backlog since we weren't here live last week, so we probably have a few of those to get through today. But again, it doesn't even have to be a stock. We have some financial questions as well that have come through. So you have a financial question, a company you're looking at. Again, go to our website, smartinvesting2000.com, and enter your question there.
And last week, I was thinking, where were we last week? But it was Thanksgiving, and we run our show that hopefully you got to catch that show because it's very informative, gives you more detail on when we analyze investments, what we look at, how we look at it. So I hope you caught that show. If not, you can see it or hear it on our website, on our podcast, but very helpful for investors on what our philosophy is. And has been for many, many years. I've been in the investment world for now 40 years, and this is what I've developed over the years to give you that not emotional feeling on investing. Well, we got a lot to go over today, so let's first start off with the annual home sales. The higher rates have put a damper on home sales, which is, no surprise. The seasonally adjusted annual sales came in at $3.8 million for October. Not only is that a decline of 4.1% from December, it is the lowest seasonally adjustable annual home sales since August 2010, which was, about 13 years ago.
Yeah, and you probably didn't catch it, but you said from December. It was from September was the decline.
Did I say December?
Yeah.
I don't feel sharp today.
I was like, not last December. It's from September to October.
How did I say that? I mean, December is not even
I don't know, but because we're in December now, maybe that threw you off.
Maybe that's it, yeah.
But the big thing that we're looking at is as interest rates pull back somewhat going forward, we could see some better home sales, but I do not believe we'll see any type of boom that will cause home prices to increase substantially. I mean, it's just a very strange market, and we'll kind of get to that. So I'm going to kind of table some of those discussions until we get to the other pending home sales, actually, what we'll kind of look at. So
yeah, we'll talk more about that when we get to the real estate market here, because let's talk about the delinquencies, because you may be hearing about the increase in delinquencies for Americans, but at the end of September, just 3% of outstanding debt was in some stage of delinquency. What you won't hear is back in 2009, the delinquency rates hit a record 12%, and going back to a more normal economy in 2019, delinquency rates were at 4.7. So again, keep in mind, they're saying, oh my gosh, delinquency is 3%. We are nowhere near any problem.
Yeah, and I mean, the other thing we look at, too, is, here's another fact for you that shows things are not as bad as the media wants you to believe. As a whole, consumers use an average of only 24.1% of their credit card allowance, which is still below 2019 when it was 24.6% of the outstanding allowance. And people want to say, I don't know, but that's getting kind of close. 24.6 versus 24.1. But think back to 2019. Were people really concerned back then?
No.
There's some people that are always, the doomsdayers.
Right.
But on average, as a whole, most people thought the economy was in a pretty darn good place in 2019. There's always a little crack, so to speak.
Right.
But nothing like you've really seen like, oh my gosh, we're going to have a recession. I'd say recession talks were very minimal in 2019.
Well, Chase, and think about 2019. Everything was, I don't want to say rosy, but looked pretty good. We had no wars with Russia and Afghanistan, or not Afghanistan, Ukraine. Nothing in the Middle East. No fear of inflation. It was a pretty good time, and that's what you have to look at. And what the media wants to do, they always want to scare people because, oh my gosh, this is terrible, and they talk about it. Well, we talk about the other side, saying you shouldn't be talking about it because it's not worthy talking about. And you also, then the worry was, oh, people won't be able to spend well on Christmas, and it's going to be a bad holiday season. Well, that got blown away this past week. I forget who it was that came out. There was some big company said, our stores are packed. We're making big sales. We're going to do very well. They think that the holiday sales will be up 3%, 4%, maybe 5% this year.
Yeah, and it was interesting, actually. I don't have the numbers with me, but I do know that, Black Friday, the Thanksgiving shopping, Cyber Monday, the results were pretty darn good there. Now, I will say I think there was a lot of demand that is essentially pulled forward. I don't think it's necessarily going to carry out in the same fashion. I mean, we talked about in the office yesterday. I did all my shopping, or I'd say probably 3/4 of my shopping over the weekend.
Right.
Thanksgiving weekend. I know you and Harrison haven't done it yet.
You're unique. You finally upgraded from your iPhone 8 to a what?
14 or 13.
So you're good for another 10 years. So you're kind of unique when it comes to shopping.
Well, yeah. I mean, I don't know what that has to do with Christmas, but the thing that I'm looking at is I think a lot of people have kind of done that. And there is, don't get me wrong, inflation has been, problematic. I'm not going to say it's like, oh, there is no inflation. Right. I mean, inflation has constrained some people's budgets, but again, it hasn't created the big problems that people have thought. And I think that with the higher prices, that's why more people like myself want to take advantage of some of the deals that took place early in the holiday season. I kind of like to get it done with too, so I don't have to worry about it. There's a lot of other things around the holidays going on. So it's like, I'm done shopping. I think you will see, I don't want to say a softening, but not an acceleration in spending as we go through the rest of the year.
Well, and I almost feel we should kind of get away from this, Black Friday thing, because back when I was younger, back even, 40 years ago, Black Friday was a big thing because before Thanksgiving, you had nothing. You now go to Costco at the end of September, you see holiday gifts, you see holiday trees, you see... So the spending actually starts. And I know that they're not going to put it up and just let it sit there. People are buying it. And so what you do have now is not we'll call it 30 days from Black Friday to Christmas. You now have, what's that, 2 months, 3 months, So it's been expanded out. So I'll say if you're spending money in September, October for the holiday season, you don't have as much to spend come, Black Friday. And so the numbers, they're much longer than they used to be, so you can't just kind of focus on that. But again, you still do, and they're still good. Yeah. So.
I mean, that's the thing, too, is you look at the overall sales, I think they're still going to be good come, I'm going to say December 31st just to make it easy. The end of the year, I think the holiday sales are going to be, I think they're going to be a good number. And, they're not, we've talked about this before, but they're not going to accelerate like they have in the past, but I still believe we will see an increase, and people aren't going to increase spending if they don't feel good.
And I'm not sure, but I believe that when they look at the holiday sales, they do look from Black Friday through Christmas, I believe is when they look at. I don't think they include what happened in October.
It's so hard because there's the NRF, there's the just kind of like Adobe now. There's so many different statistics. So I think I know there are some that include other details outside of Black Friday. I think you are right. I think there are other calculations that include the just from Black Friday. Right. So that's really where, again, you have to understand the data. And this is the big mistake. Oh, you can select a certain time period. And as you said, it's like maybe sales aren't as strong from Black Friday through the end of the year. And people are like, oh, you see, things are terrible. But if you look at sales maybe from, I'm just going to make it easy on myself, from the beginning of November
Right.
through the end of December, and it's like, well, actually, there was an uptick in the beginning of November, so through the end of the year, things were kind of normalized. But that's where people get fixated on data, and they don't understand the full picture. And that's
Right.
what we try and do is, if there's something wrong, let's say that a number looks bad. Well, why does it look bad?
Right.
Actually digging through the details to see if there's a reason for it. And I'll tell you, sometimes numbers are bad because they're bad. But trying to understand that and having that critical thinking is so important. And unfortunately, a lot of times people lack that. They just look at the headlines.
Right. Well, and actually, Friday night, my wife and I, we went to our favorite restaurant, the Winery in UTC. And I just didn't think about being the holidays. One thing nice now, you got the electronic thing say, one parking spot over there. By the time you get there, it's gone. But the parking lot was jam-packed. And it's just like, gosh, what am I doing going out here on a Friday night during holiday season to a mall? And the mall was packed inside. People are shopping, they're spending. The other thing, too, you see people carrying bags. They're not just there looking, they're carrying bags. So I think it will be a good holiday season based on what we're seeing.
Yeah, and I did want to circle back again to the whole point of this conversation was, again, the percentages that we use.
Yeah.
And we've talked about this a lot, but don't just look at absolute dollars.
Right.
That's where people blow out the headlines. Credit card spending is through the roof. People's credit card balances are at record highs. That's why we want to look at the percentages because, again, people's incomes are at record highs. People's assets, I believe, are at record highs. They may have pulled back a little bit. I'm just going to say near record highs. But you even look back to 2019, people's assets have grown pretty substantially over that time period. Their incomes have grown pretty substantially. Mm-hmm. So, yes, the spending is going to increase. That's just the way things work. That's why you look at the percentages, not the absolute dollars.
Yeah, we kind of parlayed into the holiday season, got away from the delinquencies, but yeah, I'm glad you brought that back. Let's talk about our core PCE, which is personal consumer expenditures. The Fed's preferred measure, known as core PCE, rose just 3.5% year over year in the month of October, which was down from 3.7% in September and marked the lowest reading since April 2021. Core PCE excludes food and energy from the headline number.
Now, if we look at the headline PCE, it was actually even more impressive due to lower energy prices as it rose just 3% compared to last year, which was down from 3.4% in September. This report is further evidence that inflation is continuing to decelerate and reinforces our belief that the Fed's interest rate hiking cycle, I think it's ended.
Yeah.
I don't think they're going to increase rates anymore. And it just drives me crazy where people are so fixated on what the Fed heads are saying right now. It's not even just what Powell is saying, but now what the other members are saying as well. And it's like, oh, well, they left it on the table that they still might do more hikes. Of course they're going to do that. They have to. Yeah. They have to say, hey, if inflation goes back up, yeah, we are going to have to hike rates. They're not going to say, oh, no, it's done.
Yeah.
Because all of a sudden, if inflation were to go up again in March of next year, they're going to look like idiots.
And can you imagine if they did that, saying, yep, we're done. Everything is great. Don't worry. Rates are not going to go up. They're going to go down. Go have a free-for-all. I mean, you would have that. And then you're right. If in February, March, like, oops, we now have inflation. Now we got to turn back on the spigot to cut rates. That'd be devastating. So they always talk on the side of caution, which they should. And even with that, though, we've still seen a nice decline in the 10-year Treasury. We've seen some movements in the equity side. So we're getting a good move, and we're starting to hear more about the cuts happening in 2024. I think the first one I'm hearing now is May. And I say I don't think we really need the cuts to happen because we've got a good economy, and rates are reasonable at this point. I was just concerned about them going too high when they shouldn't have had to. So
yeah, and I mean, I've heard things that it's maybe even as early as March from some analysts.
Yeah, I think I heard that. Yeah.
I've heard over 1% of cuts. I think that might be a little aggressive there.
Right.
I just think because again, we said the Fed is cautious.
Right.
And I frankly, we talked about this a lot with the whole transitory inflation. I think they were being too cautious on that front, not increasing rates. I think they're going to be cautious again going forward, not reducing rates too much. Because, again, if we still have – and I think it's possible that inflation does get, again, to near the 2% target next year. I don't think that really creates the reason to cut by a full percentage.
Right.
I mean, I think you could maybe see 0.5% of cuts. I think that's a realistic possibility, but a full percent would be pretty darn aggressive, and it could stoke inflation again if all of a sudden people start, oh, wow, this is great. No, rates are now low, and they go out spending. That could be a problem.
And I don't think we need to see any cuts until late summer, early fall. I just don't see the need for it. We've got a decent economy. Let's stay with a decent economy. Let's not. And I think the Fed would again be cautious to go back like they did in the 70s, cut too soon. So I'd say let's wait till the end of summer and fall and see how things go.
Yeah, no, I definitely agree. I was it's funny, I have these side notes today that we start with one topic and it leads down to another. But I was watching CNBC the other day. I was homesick, so I wasn't working, and I normally don't watch it during the shower.
You told me you were working at home. You weren't working at home?
I was watching CNBC, though.
Oh, okay.
Yeah.
I'll let you go.
I was on my computer and watching CNBC at the same time. But the thing is, this guy
nice
was
recovery,
on.
by the way.
Yeah. This guy was on, and he's a normal commentator, and he was talking about, just that, he thinks rates are going to come down and how the economy's it's still going to, kind of be recovering, so to speak,
right.
and it's still going to be okay. And the host was asking, so where should he be? And he's like, oh, you got to be in growth stocks. You got to be in the big tech stocks. And he's like, well, but doesn't that normally do well for value? He's like, oh, no. And the thing that just drives me crazy here is any environment,
right.
We saw increasing interest rates. Where should you have been? Oh, growth stocks. Tech stocks. Oh, things are slowing down now. Rates are coming back down. Where should you be? Oh, tech stocks. This is a big problem, and I really think things are going to slow down for those big tech stocks. Right. And even Jim Cramer yesterday, who's been huge.
Jim Cramer has
been huge on NVIDIA and those names. He said, I really think you're going to see a large broadening out in the stock market.
I think I did. Was that in the morning? I think because I think I did hear him say that not to be investing in tech stocks because they're pretty much done, but there will be, as you said, the broadening out to go other areas because that has not cut off. And we've talked about that for a long time now, how the tech stocks have just taken a big part of the market share and have been increasing, not balanced, but yet there's other ones that are behind. And I think that in 2024, that's going to be the place to be. And you may see, we've talked about this in the past, where tech stocks go up, and then they do one or two things. They either decline dramatically, or for years they sit there and do nothing because the earnings have to get up to the valuations of what they're trading at. So I think we'll see that next year.
Yeah, and when I look at it, I don't necessarily see anything that could send them down 50%, let's say. But the thing is, you never know. If all of a sudden growth doesn't come in and it comes in maybe even 5% less, that could. I'll go back to Meta. When Meta had that massive decline, it's now recovered since then. It had that massive decline. It wasn't really anything, I'm going to say, catastrophic that took down the stock. And that's what people miss, is it could just be a little hiccup. And all of a sudden, it's, a quarter, 2 quarters of, okay data, not great data, just okay data. And all of a sudden the stock falls. It's possible that does happen again with your Microsofts, your Apples, your Teslas, your NVIDIAs. It's definitely possible that happens. But even without that, if they just plateau over the next 5 to 10 years, it's not a place that you want to be.
Yeah, which we think is going to happen because we've seen this happen before in the tech boom and bust. It was the same thing. They went way up dramatically. Everybody loved tech, and then it reached the point. Nothing goes to the moon, and they cannot have these earnings that just keep growing and growing to justify, and we talked about Apple, to justify a high PE multiple of 25 to 35. It just makes no sense. And eventually it will plateau, and that's where you're going to be disappointed. Like, oh, I can't make any money in stocks. Well, no, because you missed to buy the rates companies that are trading at 10 times earnings.
And frankly, the discrepancy between growth and value stocks, again, is at just astronomical levels. Growth has done very, very well. Don't get me wrong. But the problem is, over history, when we look at the discrepancies that have occurred between growth and value, normally things reverse.
Right.
And that's where we really feel strongly as value investors that, we're going to have a comeback here, and we are going to catch back up to growth. Historically, things always revert back to that. Yeah. And when I say historically, I was actually talking to a potential client, and he was asking me about our prospects for the next 25 to 40 years. I was like, wow, that's a pretty long-term time period.
Right.
And I said, we're very confident in the value investing. It goes back to the 1920s, really in the form and fashion that we utilize. There are some earlier dates as well, but that's really when Benjamin Graham made value investing kind of more prominent. That's now 100 years ago.
Right.
I mean, I'm going to bring up Charlie Munger. I want to bring him up. Obviously,
Yes.
He's passed away, unfortunately, this last week. But, him, Warren Buffett, Benjamin Graham, they've made value investing really famous. And it's not like it's been famous, I'm going to pick on Kathy Wood, for a few years.
Right.
It's been famous and worked for 100 years now,
Right.
close to 100 years.
I get irritated when I see her on TV. I just don't like the way she speaks.
It's kind of degrading almost, or like condescending, I think is the word, where I think she thinks she's a lot smarter, and it's like, your fund's still down 70% from like your high. And it's like, if you look over her 5-year return, it's really not that impressive.
Great. Yeah, and I guess that's why when I hear her speak, I listen. Like, I don't like what you're saying, because you're talking like you're doing so well, but you're down, as you said, what, 70% from your peak? It's like, no, you shouldn't be on TV. I mean, it's just you got lucky picking things, and they went up dramatically, and I think eventually she'll be gone, because things won't come back to where she says they will.
And all of a sudden, and 10 years later, she's still not going to be at the peak that they had.
Right.
And it's going to be like, why did we leave our money in there?
Yeah, and she reminds me of Elaine Garzarelli, who you probably don't recognize. A lot of people don't recognize her, but she was very famous in the late 80s for calling the Black Monday.
Yeah.
And she was famous for that. And she was saying that, things are going to drop for like 3-4 years. And eventually you didn't hear anything more about it, because she was completely wrong.
Yeah.
So, but anyways, let's move on to the real estate market, because just how strange is the current real estate market? Well, pending home sales, which looks at signed contracts in the month of October, dropped 8.5% compared to last year, and reached the lowest reading since the National Association of Realtors began tracking them 2001. Gosh, that's 22 years ago.
Yeah, and this really means that home sales are worse now than the Great Recession in 2008, 2009. I mean, think about that. I mean, obviously 2001, yeah, that was before
that's right.
the recession. That's just crazy to me. Now, the main issues in the month were high interest rates, as we discussed, which did shoot above 8%, and also the limited amount of supply. Now, given the wild swing in interest rates, I still believe it will take a few years for the real estate market to normalize. I still believe that, we kind of talked about this earlier with the home sales, is, yes, I think interest rates are going to come down.
Right.
I don't think interest rates are going to go down to 3%. I don't even think on the 30 you're going to get a 4% mortgage. It might dip down into the 4s, but I don't think you're going to see a 4% mortgage essentially over the next 5 years. I just think that interest rates are going to stay a little bit more elevated than people were used to. But the problem is the supply is so limited out there. It's almost, I'm going to say, falsifying the market numbers, because prices haven't really gone anywhere, I'm going to say.
No.
And with the higher interest rates, that should have put pressure on the prices, but it hasn't, because the supply is so limited. So it's almost like, I've used this example before, where you have such a limited supply of a particular stock that it's not a real indicator of what's happening in the market, because the market's so limited. You could have, I'm going to say you have like 1,000 shares outstanding. That's a very limited number. All of a sudden there's only 10 people buying. Well, yeah, the price could shoot way up, but that's so small.
Right.
And it's kind of, if you get more supply out there, it really tests where things are in the real estate market. But right now, you don't have that.
Yeah, and we don't see a market crash on real estate.
No, not at all.
No, but it's just, you're not going to have these gains like you had before. And we're going to have, I think, a more normal market going forward on the real estate side as well. We might go up maybe 2%, maybe 3%, maybe 4%, maybe do nothing at all, maybe go down 2 or 3%. But the problem is, people think that real estate is going to give them these big gains based on past performance, and that's not going to happen, because same thing, valuations. The price of a home is very richly valued. I was talking to a gentleman, a neighbor of mine who's a developer, and he was talking about in Rancho Santa Fe that houses are selling for $2,000 a square foot. I mean, how crazy is that? I mean, I know Rancho Santa Fe is, I think, the most expensive place in the country to live.
One of, I know there's like Atherton up in, like, obviously.
Okay.
Yeah, it's one of the most expensive.
One of the most expensive. But it's just still crazy. I mean, and I've been to Rancho Santa Fe. I have people that live there. It's like, yeah, it's beautiful, but I would never spend 2,000 square foot to live there. And I think you get these peaks that are just here, and we're there. There's no way that things will go up higher to any big amount.
Yeah, big amount, because I still think things are going to increase in real estate over the next 10, 15, 20 years, but I just have heard predictions like, oh, well, just wait till interest rates go down to 5%, 4%. You're going to see a huge boom in prices. I don't see that. I mean, because right now the affordability is so limited that, yeah, if interest rates were to pull back, it would fix some of the affordability. But you increase prices on it, it takes you right back to an affordability issue. You know, it's a problem. Yeah. And the big thing that I think could happen is if rates pull back, I think that at that point, people that have been delaying buying a new house, upgrading to a new house would say, yeah, you know, maybe I will put my house on the market and buy something else.
Right. And another thing would be more of a natural market to where, you know, people have a family, they get married, they buy a smaller house. Then they start having 1, 2 kids, like, oh, gee, we need a bigger house. They'll buy that. Older people saying, gee, the kids have left the house now. We don't need, 3,000 square feet. Let's sell this house and buy something just for us. So you'll have these natural movements, but not this boom that we had to where everybody had to get real estate. Oh, you're missing out if you don't. Those days are gone. So any other comments on the real estate side?
No, I was just saying, I really think the big problem is it needs to normalize, and I do think it's going to take around 3 to 5 years for the real estate market to normalize. That doesn't mean you're going to see a big price drop. Again, I don't think you're going to see a big price boom. I think they're just going to kind of be this – it's going to be in flux essentially. And then I think in about 3 to 5 years you will see prices come back to a more normalized market.
Right. And I will say that, I was a big proponent of renting, which I still am, and I'll tell you why. I mean, I did find a great deal on a house, a place I wanted to live, and I wanted to stay there because one thing about renting is they can say, nope, selling the house, you got to get out. When you own it, you don't have to worry about that. But I am so pissed off because I bought this house, and I've had 2 problems already with the pool. It cost me like $1,000 for each repair. It's like, didn't have that before when I was renting, And plus the property taxes, oh my gosh.
Yeah, welcome to California.
Yeah. Oh, and then the insurance costs. I'm going to sell my house, go back to renting. Yeah. Well, if you like these topics, they come from our newsletter, which is a free newsletter, goes out every Friday at 5 o'clock. Other things we talk about here, some great topics this week was talking about the soft saving. This is from the Gen Z. You got to read it because it's pretty amazing. We talk about the environment. We also talk about vaccinations, on how the medical market for drug companies could be changing in the future from drugs to vaccinations. And then we kind of talked about it before the show, but Bitcoin, be honest with you, we just don't understand how Bitcoin is where it's at because of the fact that it is based on the hype of the ETFs, but Bitcoin is still a gambling chip. But I think you'll see this drop. But if you want more information on that, go to our website, smartinvesting2000.com. That is smartinvesting2000.com. And right in the middle of the page, you'll see newsletter. Click on that, sign up for it, and it'll go out to you every Friday at 5 o'clock. Well, I would talk more on Bitcoin, but we got so many questions here that we want to get to those questions. And I want to first start off, I think this was... came from, let's see, do we have his, well, I don't think we have a name for this person.
I forgot to ask his name.
Okay. So it is, let's see, diabetic company that I purchased about a year ago, and it is, has tanked since then. I was wondering if it is still in good shape for the long term. They just got done with a 1-year test with the FDA and are trying to compete with Dexcom. So that company is Sensonics Holding Incorporated, the symbol is SENS. So let's take a look at that company here. We see they are in the medical devices industry, which I think is a pretty good industry. You can get some good deals here. They do have almost 10% short on the float, which is a little bit higher than I'd like to see. And this is strange. Institutional ownership, only 24%. That's very low. Now, they do not have a PE ratio, which means they have no earnings. The industry is at 73. Price to sales are expensive, 18.5 versus at 3.8 for the industry. Price to book, 6.5, also about double the industry. It's 3.6. No price to cash flow, no PEG ratio. So far, not a good start here. They have no earnings over the last no earnings growth over the last year or 5 years. And then sales were up 34% for the past year, which is above the industry at 0.7%. They do not pay a dividend. Taking a look at the balance sheet, well, here's some good news. They got a current ratio of 8.5 versus 2.3, so a lot of liquidity. And the debt to equity, not a problem, 0.9 versus 0.5. So the company does have some staying power to make it through some difficult periods. We do see a net profit margin of a negative 158% versus a positive 5.5. You'd want to find out why they had such a big loss. Could have done some big investment, bought some building or something there, but want to understand that. But even return on equity looks terrible, negative 60.8 versus 10.8. And return on invested capital also negative 17.5. So got some questions here. What do you got, Chase?
Yeah, so I see current price for, again, this company, Sensonics, ticker symbol is SENS. It's 64 cents. Now, the 52-week range, the low is 46 cents and the high is $1.27. I will point out its market cap is just $311.8 million. So, I mean, this is a tiny, tiny company. And frankly, I'm kind of surprised even that there are earnings estimates, not positive, but I'm surprised there's analysts on it to provide earnings estimates, because I got to December 2024, the estimated the estimated loss per share is 15 cents.
And that's going out to December 2024. And what I also look at too many times is where the earnings have been over the last 90 days. And actually, they're getting worse. 90 days ago, they were negative 12 cents. Now they're negative 15 cents. So not a good direction on those. And that does go to 2024. 2023, they're expecting to make about 12 cents. Lose 12 cents 2023. So we just don't like to buy companies that are losing money, project to lose money. It is a small company. This is very risky, and Dexcom could be at $5 a share, a year or two from now. But
not Dexcom, Sensonics. Dexcom's way higher than.
Oh, Dexcom. I'm sorry. I just saw Dexcom.
I had to cut out. I felt like I was gonna sneeze. I was middle of my thought.
I thought you were gonna cough or something over there.
I was like, oh, give me a break. But I was gonna say, the hard thing with a company like this is, frankly, the earnings mean nothing at all. And what I mean by that is, just based off what I was told on this company and based off what I'm seeing here, is it sounds like they're going through testing right now.
This is a device maker company, so they have some device they're testing? Is that what?
Yeah. And you still have to go through testing to make sure your device works, obviously.
Yeah, sure.
Now, if the data comes back and the data's strong on it, yeah, the stock will go up. But if the data's not that strong on it, the stock will go under. It'll go out. I mean, they have a high current ratio, obviously, because they have so much liquidity. They're needing to kind of burn through that cash over a time period. And I don't know what that runway is for them to be a competitor with Dexcom. Also, maybe their technology is okay and another bigger company thinks they can come in and buy them and improve that technology. That's possible. Or Dexcom says, no, ours is better. We don't need your technology. We'll wipe you out. So the problem with companies like this is it's very hard to do fundamental analysis, which I think helps, again, remove that emotional component, because this is such a big risk that it doesn't really matter on the fundamentals of the company, because it's a guessing game of what's going to happen with the device. How successful will it be? It's kind of like a drug company that really doesn't have any drug sales just yet because they're waiting to get that approval. And yeah, maybe that drug gets approved and it's great. But if it doesn't, you have no company. Same issue here. You have no company if this device doesn't work.
And we hold a large drug company in our portfolio, and unfortunately had a drug that did not pass the FDA. They got, I think, do more studies or something. But it hurt, but not that much, because they have other major drugs as well. But when you have a company like this that is focusing on one thing, it can make or break that company to where you can make a lot of money with it because, yes, it passed. But if it doesn't pass, I think the low I saw somewhere was, I think, 46 cents. Yeah, you could definitely see it go back to the 46 cents if they don't pass.
It wouldn't even go back to 40. It'd go under.
Yeah.
I mean, if it doesn't work, you're hinging your belief on one device, it sounds like. This company's non-existent.
Yeah, and to me, that's more of a gamble because it's not based on the fundamentals. Who know the fundamentals? Again, they got a great balance sheet, so they can weather the storm. But if they don't pass that with that device,
I mean, you would have to be, a scientist almost to really understand this company. Because as I said, the financials don't really matter. It's the technology and the science behind what they're offering. And even then, you'd have to work there to understand the true details. It's as you said, it's a guess. It's a gamble. I mean, is it going to pay off? I don't know. Go to Vegas, see if you throw. I don't know. You're looking at investing, but you throw $10,000 on one hand of blackjack. Hey, maybe you make money. You know,
I'm going to Vegas next week. I'm thinking like, I would never do 10,000. I have a hard time gambling $500, even as much as I make. It's just like, because I know I'm going to lose it. Yeah. You know, it just makes no sense. And the same thing with the Sensonic. I just, there's potential there to maybe have a big return. And then what people say, well, I'll just throw a little bit of money at it. Well, but you do a little bit of money there, a little bit of money over this one. Just don't do that. I mean, just, if you're looking longer term, just buy good quality businesses, hold on to them. And maybe it's exciting, but I don't know.
And maybe it does hit, but maybe it doesn't, and you lose everything. That's where you got to go back to my the post I wrote on soft saving. Because I talk about compounding, and if you don't compound, there's big issues.
Yes, and that's why, again, you got to get the newsletter, because it was a pretty long one, and it was really good on the soft saving thing, but I just thought, and plus all the numbers there, you really got to read that. It's kind of hard to actually talk about it on there. All right, let's talk to, he is there, our financial planner, Harrison Johnson. Harrison, how you doing today?
I'm doing well, guys. How are you doing?
Well, good. Thanks for being here today. I know you got, I can't find the notes here on what your topic is today, so I'm going to turn the mic over to you.
So what I wanted to talk about today was income versus cash flow. Everyone wants to have more income, but it's also important to understand your income and cash flow and how income and cash flow are different, especially when preparing for retirement. Income is what you have to report to the IRS and determines how much you pay in taxes, while cash flow is the actual dollar amount of funds you have coming in from various sources. Income and cash flow often get confused for being the same, and at times they can be, but depending on how you structure your income and cash flow, one can be larger or smaller than the other. And typically, when you are retirement planning, you want to plan to create a certain level of cash flow that will support your lifestyle, and separately, you want to set a target income level so that your adjusted gross income and taxable income stays within the right parameters. So here are some examples of what I'm talking about. I met with someone this last week who is getting ready to retire, and they want to live on $20,000 a month, or about $240,000 a year. So that's the cash flow we are planning for. However, they have a sizable amount of assets in a non-retirement account, so we will be able to generate that $20,000 a month, but on paper, it's only going to be reportable as $5,000 to $6,000 a month, depending on the level of capital gains and dividends they end up having. So in this case, they have their cash flow of $240 a year, but they'll only report income to the IRS of about $60 or so, and will pay far less taxes on that. Now, we could leave it at that, but they also have a sizable pre-tax retirement account, which will eventually push them into the highest tax bracket in about 15 years, due to required distributions. So to combat that, while they are withdrawing from their non-retirement account, we will also be converting their IRA to their Roth so that their income reaches around $365,000 now, which is the threshold between the 24 and the 32% tax bracket, which will ultimately ensure that they never get subject to that higher tier of taxes in the 33, 35, 39.6% range. So these conversions do not change their cash flow, but they increase their income to a target level that will reduce their lifetime tax bill, in this case by about $12 million or so. The goal here was to have a higher income than cash flow, because in the long term, that's going to give them the cash flow they need, will also reduce the taxes paid, and also result in a higher net worth over time. So in other cases, it makes sense to have a lower level of income than cash flow, in which I met with another person this last week and basically said, okay, your target income is $22,000 a year. To which she said, there's no way I can live on that, which is probably true. However, her actual cash flow is going to be about $90,000 a year coming from Social Security, IRA withdrawals, and Roth withdrawals, in a way that most of her Social Security is not taxable, and the remaining taxable Social Security and IRA withdrawals are offset by the standard deduction, meaning she will pay no taxes at all on that $90,000 a year. So in this case, we wanted income on paper to be less, and then cash flow, can be a lot higher. So The point is, a lot of people think cash flow and income are the same, but they are not. They should be planned separately so that you can generate your needed cash flow to live and enjoy your life while also keeping your lifetime tax bill as low as possible.
And Harrison, and listen to you talk here as people are as well. The thing I'm thinking too is like people have to start planning for this. You have to lay out the plan. It doesn't just happen and fall from the sky.
That's exactly right. And when you look at the planning over the long term, you go through a phase where you are accumulating assets, you're in your career, you're working, and it's one thing to accumulate assets, but it's also important to plan and accumulate them in the right way, because ultimately we accumulate assets to generate a future source of cash flow. So if you can accumulate assets and put them in the right types of accounts, use the right types of assets, that means when you transition into retirement, well, now you have everything set up efficiently so you can start withdrawing and, again, generate that cash flow you need. It just looks a whole lot less on paper, so overall your lifetime tax bill is much, much less.
Right.
Yeah, I was going to say, it's very similar to understanding businesses, and income and cash flow are functions of one another, but you need to understand both. They're not always going to move in kind of correlation, and that comes down in personal financial planning to understanding really the taxability of it, and that's where I think a lot of people, I'm going to say, just lack the knowledge and the resources to understand that, and that's obviously where you kind of come into play, Harrison, to break that down, because again, the average person, what do you mean there's a difference between income and cash flow?
Yeah. At face value, it seems like they're exactly the same. And you're right, Chase. In companies, it's also the same. That's why you have cash flow reports and income reports, because again, one determines the income tax you pay, the other determines how much cash you have coming in and going out. And a lot of people, I think, don't look on it on the individual side, and they just say, okay, well, you make more money, you pay more taxes, and depending how you structure the actual cash flow, that doesn't always have to be true.
Right. Well, Harrison, as always, very good information for people. And if they want a free consultation, we'll tell them how they can contact you. But thanks for being here, and we'll see you on Monday.
All right. Thanks, guys. We'll see you Monday.
All righty. Okay, again, that's Harrison Johnson, our financial planner. He is a CFP. And by the way, he's on a salary. He does not sell, annuities or life insurance or high commission products to make his money. He's on a salary, so he is unbiased. He's a fee-based planner. If you'd like a free consultation with him, give him a call at the office, 858-546-4306. Again, 858-546-4306. Or go to the website, smartinvesting2000.com. Again, that is smartinvesting2000.com. And I just love, because Harrison's office is kind of like, I guess, kitty corner to mine. And, I can see he spends a lot of time with people to really answer questions and really lays out and asks good questions to get questions to people to ask. Well,
yeah, our whole job is on investing is we want to find good investments, right. And we spend a lot of time on that research. Harrison's whole thing is I'm going to say much more personalized, where he needs to understand your whole situation, needs to look at all the details that you have, and a lot of that comes from just listening and understanding what things are so you can formulate a good plan. It's like you go to somebody and you give them a little bit of information. You can't generate a good financial plan with that. You need to have that understanding before pulling all the details together.
And the thing I always say, too, is that his whole job is financial planning. He's not spending part of his time looking at mutual funds or what to do with the economy, and he knows stuff like that, but his job is spent looking at doing a financial planning for you. Our job is actually managing money. So it works out very well. And again, you don't need to do the investing with us to have a financial plan with Harrison. Maybe you have some real estate. Maybe you have some things that you're kind of doing yourself, but you want a good financial planner. You can use Harrison since he is a fee-based planner. Again, 858-546-4306. And I think he's number 4 or 5 on the prompt, I believe, somewhere around there.
My guess would be 4.
4. Okay. Well,
or go to also very easy, go to the website, smartinvesting2000.com, and fill out the appointment request.
There you go. All right. Well, let's go back to our email questions here. And if you do want to submit a question that you have on investing, on a company you're looking at buying or selling, go to our website. Again, that's smartinvesting2000.com. That's smartinvesting2000.com. And right in the middle of the page, stands out pretty well. It says Smart Investing Show Questions. Just click on that and you can submit the question. So I got a question here from Robert, which is a quick one here. He says, why do you feel your method of investing is more profitable than mutual funds with an investment company that has low fees? And he says, thank you for the answer to that. That is so easy, so complex to answer.
Well, there's so many different thoughts that I have, and I don't know if he's asking, and I can kind of go two ways with this, if you go to an advisor to use the mutual funds or if you just do the mutual funds directly yourself. I'll start with the first one. If you use an advisor to use the funds, well, we always tell people you're paying double fees, essentially, where you're paying the advisor fee, what's their fee, and then you have to know what all the mutual funds they use is and what's the fee within those funds. Now, if you don't use an advisor and you go directly to the fund, well, the problem is, what philosophy are they really using? You can't ask, you can't call up the mutual fund manager and be like, hey, why'd you pick this company? That doesn't make any sense. So you'd really have to dig through the details to understand their philosophy, understand how they're picking things. It's going to be a little bit more complicated, I would say.
And one thing I've, again, been doing this for nearly 40 years is that people say, well, I'm just going to go to the mutual funds and I'll just pick different mutual funds. Well, you can have, we talk about overlap, to where you might be picking 3 different funds that have, 5, 6 of the same companies in them. It just makes it so hard to get any performance from that. And I always tell people, because when we quote our returns, we don't quote them on air because it's illegal, but when we talk to our clients, we always quote our returns net of all fees and charges. Mutual funds don't really do that.
It's complicated.
It's complicated, yeah. So, but it's not just like, well, you might have, if you put everything in one mutual fund, it might be easier. But then no one does that.
No.
Because you're taught, well, no, you can't do that. You've got to have different mutual funds. You've got to diversify. What we look at is that, no, we invest our money for profitability. And people say, well, what about, asset allocation? What about, older, younger? What I said years ago was everybody wants to have make money on their portfolio. That's what our thing is. It's not to worry about asset allocation. We explain about volatility. We explain about all these different things to educate you on investing, not just take what I will call the couch potato approach, just sit on the couch and just pick a bunch of mutual funds and let them roll. That has not turned out very well for many people, especially people that had bonds. A bond fund over the last few years.
Yeah, I mean, that's the big thing. Again, I talked about why I don't think it makes sense to go to an advisor to do the mutual funds, but if you're doing the mutual funds yourself, the likelihood you pick one is very low. I would say most people are going to pick a few different ones. So then it's like, well, what is your philosophy on investing? Now you're kind of having to come up with your investment strategy with that. Where you come to us, we tell people, this is our philosophy, this is why we pick things, and, my money, Brent's money is invested the same as all of our clients. That's what we're doing, where, you're kind of on your own with the mutual fund investing. And the other thing we talk about, too, is the net redemptions. Is a lot of people don't realize that in mutual funds, you're pooled in with all other investors. So what happens during a downturn, people panic, they sell, they want to redeem their shares. Now fund managers actually have to make sells within that fund to then meet those redemptions. So then they make those sells. Well, now your ownership in those businesses now become diluted or completely disappeared. So with us, we actually individualize all of our accounts. So that way you actually own 100 shares of XYZ company, 50 shares of ABC company. You own those positions. Our other clients aren't lumped in with you, so they don't have an impact on your portfolio. And also on those redemptions, as I said, fund managers are forced to sell things. Well, what could happen is things go down, they're forced to sell something. They might not want to sell the ones that are down. Right. They might sell the ones that are up. Now, you don't have any control over that. They made those sales. You get hit with a tax bill because they have to distribute those gains.
You just took away what I was going to say, because that's actually my segment tomorrow morning on KOSI, which, by the way, usually on KOSI, I'm on at 8:40 on Sunday mornings. They asked me if I can come in at 7:40, so I can come an hour early tomorrow. But that's what I'm talking about, is that you don't know that. And if you have an advisor, their job should be saying, hey, we've got this coming up. You need to do something. But if you're doing it yourself, it's going to happen. And once it happens, you can't reverse it. Then you got to kind of, well, how do I fix this? So there are ways to fix it ahead of time. But these are things, if you're doing it yourself, no one's going to, the mutual fund company is not going to tell you, hey, by the way, in a couple of weeks, we're going to distribute some capital gains, which you got to pay tax on. Yeah. But well, wait a minute, I haven't made any money. Too bad. You got to pay tax on it. So this is where an advisor can be helpful. And if you do have an advisor and he doesn't tell you this, you probably want to fire that advisor because he's not doing his job. He's more worried about getting more sales in than taking care of his current clients, where, wait a minute, you didn't tell me this. And now what do? I got to suck it up and pay taxes. I remember when I first got in the industry, gosh, back in the 80s, I remember that happened to me, like, oh, shoot, I screwed up.
Yeah.
It is a screw up by the advisor.
Yeah, and I hope that kind of covers it. But there are more details, and some of it can be a little complicated. So if you do have further questions on how we do things and why we are better than a mutual fund in our belief, set an appointment with us. We're more than happy to go through the actual nitty gritty and the details to kind of show you again why we strongly believe our philosophy is better than the mutual fund strategy there.
Yeah, and one thing too, I kind of look at by going into for the appointment. Well, I think we have. And again, I've not seen a lot of other presentations, but our presentation, I think, is very well laid out. It's built well over 20 years where people would ask questions. We'd say, well, that's a pretty good question. Let's add to that. And it just helps educate you. And that's our whole thing, is educate people on investing. We don't have any magic secret sauce or anything. We use the true fundamentals and explain to you what's going to happen. And we actually tell people, out of a 7-year period, guess what? You're going to have a couple losing years. It's going to happen to you. So don't think we're going to avoid it, because you're not. So even Warren Buffett's had losing years.
Yeah, it happens. It's the reality of investing.
Yeah. So, all right. This one here says, let's see, I am a former client of yours and and I would call into your radio program on Saturday mornings every so often to get a take on a particular company. I work at a company where Dish just installed cellular equipment, and when talking to the area construction manager, he was noting that over the next few years, Dish will be installing many more, hundreds, maybe more of these installations. He also indicated the price for cell plans, and they seem very competitive if true. Apparently, since Spring and T-Mobile merged, they are not allowed to retain cell site on locations where both carriers were present. Looking at financials in light of what you taught, it would seem this company may be worth investing over the long term, which is what you normally like to do. Just curious if you guys looked at this company recently. Hope you're doing well, and I always appreciate your personal communication when I was your client, and even for a period of time after that. I still enjoy reading the newsletters. Trev. So he didn't give me the symbol on
It's
that.
easy. It's Dish.
Yeah, that's what I thought it was. It is Dish, yeah. So, and I've seen a lot of negative on Dish. I mean, he talked about the pauses, but I've seen a lot of negatives on them recently, news-wise. So.
Yeah, I mean, I don't know. I haven't really followed it that closely, I guess. But, I don't know, I guess. Obviously, the problem is if they're trying to still, do they still have Dish TV? Is that still a big thing for them? That obviously has been hurt quite substantially by streaming, and I know Spectrum has been, quite aggressive in trying to price things properly as well. And if that's all Dish's main money sources, it could be a big, big problem.
Yeah. So let's take a look at the numbers here at Dish. Their symbol is, as you said, very easy, DISH. They're in the telecom services industry. Wow, high float here on the short, 31.4%. I don't remember seeing anyone that high in quite a while, which says that a lot of people think the stock is going to be declining. 85% institutional ownership. The PE ratio, wow, this looks very enticing as well, 2.1 versus 25 for the industry, but there must be a reason for that. Price to sales, 0.2 versus 1.2. Price to book value, 0.1 versus 1.6. That means you're paying 10 cents on the dollar for the price of the book value of this company, which is pretty low. Unfortunately, when we see the earnings, we see earnings for the company are down 36.9% over the last year, industry up 8.5%, and even sales for Dish have declined by 8.6%, industry down 2.4%. They do not pay a dividend. Taking a look at their balance sheet, we got a current ratio of 0.5 versus 0.8. That worries me a little bit because they could be getting close to a point to where they don't have liquidity to pay their debt. Debt to equity 1.3 versus 1.7. Not bad, but again, with that low current ratio, that does worry me. Net profit margin shows 7.8 versus 6.5, and return on equity is 6.7, about half the industry at 12.1. Chase?
Yeah, so current price here for Dish, $3.92. I see the 52-week low, $3.21, and the 52-week high, wow, $16.45. So I see over the last year it's down about 75% for Dish. Also, even over the last 5 years, it looks troubling. It's down 88% over the last 5 years.
I know they've had trouble. Yeah.
Going forward as well, more concerns going out to December 2024. They're estimated to lose 20 cents, and that's even more problematic because I look at 2023, they're actually estimated to make 27 cents. So I don't know if they're estimated to have profits this year from selling assets potentially or what, but I mean, to go from a profit of 27 cents to a loss of 20 cents per share, that's a pretty substantial decline over a 1-year time period.
And I say we got like 12 analysts here, and someone does think they'll make 40 cents in 2024. But on the downside, somebody's looking for a loss of 261. And also going back 90 days. 90 days ago, the mean of the analysts said, no, they're going to make 38 cents in 2024. But now, as you said, it's a loss of 20 cents. So, yeah, there might be some good sounding things here. The debt's not too bad, but the liquidity kind of worried me. I just don't think it'd be worth the risk here on this, and I'd have to pass.
And again, I mean, maybe they get acquired by somebody, but again, that's just such a big maybe. I don't know who would acquire them.
And I just say why? Why would you want to acquire this company? I mean, it doesn't seem to be the direction. You know, I mean, I'm sure they do the streaming and everything else, but it's just I don't know. I don't get the point of it, and I hate it. You see a house with that dish on the side of it? I always hated that look.
I think I have a dish on top of my house right now.
Do you really?
Yeah, I don't use it, but once you put it up there, it's kind of there.
Yeah. You know, you're trying to become a permanent fixture because nobody else takes it down. I know the last house that I rented, they did have one on there. It was like up on the house, and I wouldn't use the service, but the dish was still there.
Yeah, because why would they pay somebody to come take it down for you?
Yeah, because I guess they put it up for free.
Yeah, I'd assume.
Yeah.
I don't know. I think the numbers are not enticing for Dish. It's definitely, I mean, I saw they were up like 7% yesterday, so I bet you it's a pretty volatile stock, and especially with the amount of short position on that. I mean, yeah, it could move up and down quite aggressively, but it's not one that I guess I would be interested in holding for the long term. And obviously we don't trade, so I'm not interested in holding in the short term either.
Right. And actually from that last question we talked about, you know, how we do things compared to mutual funds, we're buying businesses that are strong businesses. I don't see that as a strong business. I'd probably want to I'd say no.
I'd look elsewhere.
Yeah, it doesn't mean it won't go up. Doesn't mean it couldn't turn around. But there's no reason, and that liquidity really worried me quite a bit.
Yeah, well, liquidity is such a big issue because, especially in a time period like this where it's hard to finance good debt, and especially you don't have good numbers.
Right.
You know, who's going to want to give you a credit line? And then all of a sudden you get a credit line with high interest rates, and all of a sudden has debt covenants on it. You borrow that money on the credit line, all of a sudden it comes due, and you're screwed. So right. It's just liquidity, I think, is very important, and you don't want to see this business have to go through a liquidity crunch.
And wasn't there another one besides Dish?
DirecTV.
And are they gone? Are they even around?
I know my Dish on top of my house is DirecTV, and no, I used DirecTV Stream for quite a while.
Oh,
so
you did?
They used to switch to a streaming platform. I thought it was pretty good. I liked him for the Padres, but now that the Padres have kind of the direct-to-consumer service, that's what I'm going to do next year is I moved to Sling TV. It's about half the cost is DirecTV Stream, and then when Padres play in season, I'll get the
right.
direct-to-consumer service.
And I still don't think these Dish services during bad weather still have that resolved. I think you still during bad weather.
I remember I had DirecTV in college, and it snowed in Flagstaff, so during a snowy day, you're like, oh, man, you're stuck at home and you can't even watch TV.
Well, you know what, Chase? I got to say, we did a terrible job today getting through these email things. I mean, we always, the show just goes by so quickly. But we've got them here. We'll do more next week, actually. If you want to ask your question as well, go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Right in the middle of the page, you got Smart Investing Show questions. And I looked at, we got some great ones here from a Joel on Spirit Realty. Another one here from Sean asking about, what's this question here? LAC, you know, another company where you see it going. Another one from Jan. So we will get to those next week. We'll have to pick up the pace a little bit. I just like talking about things, and what we're doing when we answer these questions, it's like we're having the conversation we have in the office about when we're investing money for our portfolio.
And frankly, I don't want to speed it up because I want to take the time for each question. Yeah. You know, I think it's more valuable to go through the details, and you know, I could go through it very quickly and give you a 30-second, 60-second answer, but there's no value in that.
That's true. Good point. All right, we won't speed it up. We'll just do it normally then. So, all right, well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. Again, that's 858-546-4306. And be sure to visit that website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. Also, the Smart Investing Show questions and the newsletter you can sign up there as well. Have a great day. We'll talk more next week right here on the Smart Investing Show.
To think